Okay, welcome everyone to the Nelson Capital Fall presentation. Our presentation this year is entitled Hazards Exist That Are Not Marked. If you're a frequent skier or snowboarder, you may be familiar with this sign at the top of the mountain, alerting you to the fact that although the powder may look fresh, there can be rocks, there can be tree stumps or things underneath that can really trip you up. Today, the economy appears to be on strong footing. The market's just off an all-time high. But what we're going to do is kind of look underneath the surface a little bit and try to identify some of those hazards. Before we do, I want to start off by introducing our team. As presenters today, we've got the Nelson Capital Partners, Brooks Nelson, Steve Philpott, Darcy Nelson Smoot, and I am Evan Nelson. Also presenting today, we have Chrissy Deonda. Rounding out our research team is Ann Oglesby and Donald Horton. And then we've got our great support staff in Marissa Wisniewski, Tiffany Garcia, and Kelly Bojo. We will be doing a Q&A session at the conclusion of the presentation, but feel free to pose questions throughout. You can do so by clicking the Q&A button at the bottom of your meeting controls. We will address as many as possible as time permits. And with that, I'm going to pass it off to Chrissy.
Thanks, Evan. So I'll start today by discussing asset class returns. So in dark blue and dark gold, we have year-to-date returns, and in light blue and light gold are the third quarter 2024 returns. From a quick glance, you can see that we've had positive returns across all asset classes. So starting at the far left, the two bond indices that we have listed are Barclays Municipal and Barclays Intermediate Government Credit, and each of those saw mild increases in both the third quarter and year-to-date. Small cap, which refers to small company stocks, were up about 9% year-to-date, but saw the strongest performance in the third quarter due to easing inflationary pressures, supportive central bank policies. International stocks, both developed and emerging, are up low to mid-teens year-to-date and high single digits in the third quarter. And this was mostly due to easing inflation and supportive central bank policies, which help support international stocks. The NASDAQ Composite, which looks at, is comprised of many tech-focused companies, continued its momentum from 2023 and is up about 22% year-to-date, driven heavily by artificial intelligence euphoria. However, in the third quarter, we saw some more muted returns, up just about 3%. And then lastly, we have the S&P 500, which was up a little over 22%, driven mostly by these tech-focused companies. The index increased 6% in the third quarter as the market rally extended beyond tech stocks, reflecting resilient corporate earnings, easing inflation pressures, and the potential for future Federal Reserve rate cuts. Now, looking at returns from a sector perspective, we've seen three sectors outperform the S&P 500 on a year-to-date basis. So we have utilities, technology, and communication services. The utilities sector is the best performer both year-to-date and in the third quarter, and this is mostly driven by a lower interest rate environment, which makes utility stocks more attractive to income-seeking investors. The sector's also benefited from increasing energy demand due to the rise of data centers that are needed to power this AI development, as well as government incentives from the Infrastructure and Jobs Act, as well as the Inflation Reduction Act. Technology's outperformance year-to-date was again due to the optimism surrounding the expected productivity gains related to artificial intelligence. Communication services is also up nearly 30%, primarily due to a resurgence in digital advertising. And energy, although it was the worst performing sector year-to-date, it still posted positive returns of over 8%. And then in the third quarter, we saw energy, technology, and communication services as the worst performers. Energy returns were down about 2% due to concerns about a potential softening in global demand, and this coincided with a buildup in crude oil inventories, which created a downward pressure on oil prices. Technology and communication services took a breather from their recent rally. While they still posted mild gains in the third quarter, superior performance in other sectors helped to broaden the stock market rally. So the S&P 500 is a market cap weighted index, which means that it allocates weights proportionately to each stock based on its market capitalization, meaning that larger companies like Microsoft, NVIDIA, and Apple tend to dominate the index, and so performance is often driven by these largest companies. The equal weighted version of the S&P 500 allocates the same weight to every stock, giving smaller companies more influence. And so this version of the index tends to outperform during periods when smaller or undervalued companies tend to rally. So we saw this happen in the third quarter as the S&P 500 equal weighted index, which is the gold line on this chart, outperformed the market cap weighted index, which is the blue line, by about 4 percentage points. The stock market rally broadened beyond these large tech companies as strong performance by utilities, real estate, industrials, and financial companies led the equal weighted index higher, while an underperformance in technology and communication services were a drag on the market cap weighted index. Alongside the strong market performance we've seen this year, we've also seen valuations continue to climb. So this chart displays the forward price to earnings ratio, or PE ratio, of the S&P 500, which divides its current indice price by forward earnings estimates. So this reflects how much investors are willing to pay today for future earnings and helps to assess whether a stock is overvalued or undervalued based on the projected profitability. Here we can see in the late 90s to early 2000s, during the dot-com bubble, forward valuations spiked to nearly 26 times forward earnings. And when the bubble burst, valuations dropped to about 15 times earnings. By the time the financial crisis hit in 2008, 2009, and we saw the subsequent fallout from that, we saw valuations drop to almost 10 times. Since then, valuations have drifted higher, but in 2020, as the COVID-19 pandemic struck, we saw valuations spike to levels that we hadn't seen since the dot-com bubble. And this was mostly reflecting the investors' optimism about a future recovery despite the short-term earnings challenges that companies were facing. So valuations softened again in 2022 as the Fed raised interest rates due to persistent inflation, but by late 2022, we got a new wave of optimism surrounding generative AI, which drove valuations back up to its current euphoric levels. So the S&P 500's forward PE ratio now sits at about 22 times as it approaches the levels that we saw during both the pandemic and the dot-com bubble. It remains well over the 30-year average of about 17 times, signaling that the market is expensive. At these levels, the markets are priced for perfection, leaving little room for error as earnings expectations remain ambitious. I'll now pass it along to Darcy to discuss the economy.
Thank you, Chrissy. So Chrissy mentioned a couple of different points that I'll just reiterate. Every asset class has been up this year, and valuations are pretty expensive as far as the stock market is concerned. So why is that? I think that generally speaking, investors are excited about prospects for the stock market. They're investing in the stock market. They've pushed it to valuations that are near historic highs because there's an expectation that the US will achieve a soft landing scenario. And what that means is inflation has come down. The expectation is that it will continue to come lower without us going into a recession. That is the definition of a soft landing. And at this point, that's kind of what everybody believes will happen. So this chart is looking at recession probability based on an economist survey done by the Wall Street Journal. So the Wall Street Journal surveys these economists and says, do you expect we'll see a recession in the next 12 months? Yes or no? And then we get the response rate charted historically on this chart. So for most of the post-Great Financial Crisis era, there really wasn't an expectation of an imminent recession. A couple times where things got a little volatile, and there were a few more economists that said, okay, maybe this time. But really, the big spike on around 2020 was, of course, due to the pandemic, where basically every economist said, yeah, we're heading into a recession because of this. But we know that there was a quick recovery. And in fact, by 2021, we were back to historic lows of this survey, and basically no one was expecting a recession. Then in 2022, as Chrissy mentioned, inflation reached a peak of 9%, and the Federal Reserve really had to get serious about bringing that inflation down. So they implemented one of the most aggressive rate hike campaigns in the last 40 years. And pretty soon, by about the beginning of last year, more than 2/3 of economists answered, yes, I think we are going to enter a recession. But since then, that has drifted down. And now this probability is back to about 1 in 4 economists thinking that we might hit a recession sometime in the next 12 months. So there is some data to support that soft landing story, and I'll go through a couple of those data points right now. So the first is inflation. I mentioned this before. Inflation has come lower. So from that peak of 9%, we have approached a much lower level. So this chart is showing CPI in blue, which is the Consumer Price Index. It's a basket of goods and services that's calculated to kind of give an idea of how much are goods and services costing and what is the rate of change of those prices. Core CPI, which is in gold, strips out food and energy prices, which tend to be very volatile. So from that peak of 9%, headline consumer price index or inflation has come to about 2.4%. That's great news. The Federal Reserve's target is 2%, which is about, right around a 50-year average of inflation. Core CPI, though, has come down off of its highs, sure, but it does kind of seem it's stuck above 3%, which may be a bit of an issue. But the good news is the soft landing proponents say, hey, inflation has come lower, and that's true. So looking under the hood at these inflation components a little bit, this is showing the CPI, that blue line chart that we saw on the last slide. This is looking at what's driving that number. So we had the peak at 9% around the middle of 2022. A lot of that had to do with the fact that energy prices had spiked in the wake of the Russian invasion of Ukraine. So since then, energy prices have retreated. Energy is actually now becoming a bit of a drag on the inflation value, which is, a good sign. Similarly, goods, during the early days post-pandemic, we had supply chain issues, and the fact that everyone's stuck at home, not able to spend on services, was instead buying goods. That supply and demand mismatch caused the prices of core goods in orange on this chart to spike and actually be a significant driver of inflation. So that also has retreated. These supply chain issues have been worked out for the most part. And so those are no longer the big problem with inflation. But if we look at some of the other pieces here that are driving inflation in more recent quarters, or more recent months rather, shelter in dark blue is the biggest one. Now, this is not surprising. Shelter is what most of us spend the majority of our dollars on, but it's not home prices and it's not rental prices. It's owner's equivalent rent. It tends to be a data point that lags the actual hard data with home prices and rent prices, because it's a survey where homeowners are asked, what do you think your home could rent out for? The expectation is, we've seen shelter prices rise post-pandemic through 2022 and 2023, but we've kind of reached an inflection point, and most people who believe that inflation will continue to trend lower think that it will be because shelter prices continue to come down. That's taking longer, I think, than everyone is expecting, and that's why it does feel like that core inflation number is kind of stuck and having a hard time getting back down to 2%. The other components that are driving inflation right now are dining, recreation, and other services. I think anybody who's gone out to dinner recently may have noticed that those prices are still very elevated. And you have things like auto insurance. Now, auto insurance typically is about a 3% weight of the inflation basket in terms of how that basket is calculated. But because auto insurance is rising at around 25% year over year, it's having a meaningful impact on inflation. And none of us really see a path as far as when that starts to come lower. So these are kind of the question marks, or some of the hazards under the hood of inflation that may challenge that assumption that inflation will continue to trend lower. The other story of why we might see a soft landing with inflation coming lower is is the labor market going to be impacted? And so far we haven't seen a significant negative impact to the labor market, even though the Federal Reserve has done this aggressive interest rate hike campaign. So the top chart here in blue is showing total non-farm payrolls in the US. This is a metric that tracks job creation. When the pandemic hit, there was an almost overnight loss of about 20 million jobs. About half of those came back relatively quickly, and then it took a while longer to get back to pre-pandemic levels. And we've seen job creation that's been quite strong. And in fact, we've seen this value continue to climb up and to the right, which is good news. The unemployment rate on the bottom is also near historic lows. After the pandemic hit, we saw a very sharp spike in unemployment, but again, people either found employment subsequently or exited the workforce in some cases, and we're now at 4.1% unemployment, which really it's a 20-year low, and it is near historic lows at this point. So broadly speaking, inflation has come lower. The labor market has not been severely impacted. That is why I think the market expects a soft landing. I'm going to pass it over to Brooks now, who's going to talk about some of the other hazards that may not be marked and hiding underneath the fresh powder.
So if you go back to that previous slide, Darce, what we've done traditionally is follow two very key indicators that almost always signal when a recession is going to start. One of them is job growth, and I'll talk about that. And the other one is the change in the interest rate environment, which Steve will address when I'm done. The job growth numbers that you see here obviously were rather displaced by the pandemic. And that may be one of the reasons that this indicator, job growth, is maybe not as good as it has been throughout the decades. The next slide, what we're going to show is the year-over-year growth in non-farm payrolls. And what has been shown really since the end of World War II, whenever non-farm payroll growth slowed and went through 1%, it was almost at that moment that a recession has started. We're getting closer and closer, but we haven't crossed that line. An analogous and similar looking at the same kind of data has been promulgated by Claudia Sahm on the next slide. What she's looking at is not employment, but unemployment. The Sahm rule also has been almost 100% accurate in predicting when a recession starts. What Claudia Sahm does with her rule, she takes the 3-month moving average of unemployment claims and compares it to the 3-year moving average. And when the difference between the two is greater than 0.5%, 50 basis points, traditionally it has always signaled the start of a recession. Interestingly, the Sahm rule was triggered August 6th with the July payroll report. Even Ms. Sahm said maybe it doesn't apply this time. So and that the questions about that are really due to the impact of pandemic on employment and unemployment. So looking at the next slide, we find this to be very interesting. Every year, the Bureau of Labor Statistics makes revisions, which they do constantly. You know, what gets reported on the first Friday of every month is the non-farm payroll numbers, but they also add revisions to prior months. And then annually, they make a very can be modest or a very significant revision. This year's final preliminary revision to the year prior was over 800,000 jobs, which is, you have to go back to the financial crisis to see a BLS revision of that size. So the numbers are definitely suspect because of the revisions and all of the changes that are going on with the pandemic's influence. But we're starting to see things that concern us. The next chart shows household excess savings that were created by the reaction under the Trump administration, when the pandemic hit. Lots of money was spent to stimulate the economy. Much of that money went directly into banking accounts because people couldn't travel, they couldn't go out anywhere in the early months of the pandemic. And what we saw was an increase in peak excess savings of 2.3 trillion and very large increases in personal savings. That's the dark blue line. That's since come down. The personal savings went negative in 2022 as people started traveling, the revenge travel phenomena, and excess savings have come down dramatically. This is starting to show, particularly in lower quartiles of economic prosperity, those folks at the bottom of the demographic are having a very difficult time. And looking at the next slide, I'll show you what we're talking about. We're starting to see delinquencies picking up. If you look at the auto loan, the blue line, at the credit card rates, these are now at levels that are above where they were before the pandemic. Even mortgage delinquencies have started to pick up a little bit. The one outlier on this slide is student loans. Well, that's because they've been placed on hold by the Biden administration and have not been forced to come back and make those payments. The folks that are borrowing on credit cards and taking out auto loans are typically lower economic bracket consumers, and those consumers are having the most difficult time, as evidenced by the dollar store, Family Dollar Store, Dollar General, etc., having very difficult earnings problems. So with that, I will pass it off to Steve to address the interest rate environment.
Thanks, Brooks. Yeah, in the next few slides, we'll take a look at data that we're looking at either on a daily or weekly basis. And we'll start by looking at the U.S. Treasury yield curve, which gives us a snapshot of where Treasury yields are for varying maturities of time. So the data we're looking here is a comparison of two curves. The first one, or the gold line on the bottom, is where interest rates were at the end of 2021. The blue line shows where rates are today. So the important takeaway here is that rates have moved higher across the curve from where we were almost 3 years ago. The biggest change you'll see on the bottom left there is where short rates have moved higher. That's a result of Federal Reserve increasing rates to combat inflation. And just if we stay there, look at the actual interest rates in the bottom left of the corner, you can see that the 1 month or 30-day Treasury bills were yielding close to 0% back in 21. Today, they're yielding about 4.6%. And then if we look at the longer end of the curve, so maturities between 5 and 30 years, now these rates are more impacted by supply and demand. So in other words, the amount of supply being issued by our government, and then the demand from both domestic and international buyers. So as we get more demand from buyers, rates tend to come down. As more supply comes online, it tends to push rates higher. And we're in this position now where many believe that, given the large deficits that we're running as a country, and I think now we're closing in on almost $35 trillion in debt we've already accumulated, and the fact that neither presidential candidate has mentioned anything about spending cuts, we do expect to see more supply come online, which means higher rates, or we should expect higher rates in the future. This next slide looks at the inverted yield curve. So the market watches this relationship between the 2-year and the 10-year treasuries rather closely. Similar to the Somm rule, it's been a good recession indicator over the years. In fact, every recession since going back to World War II has been preceded by an inverted yield curve. So typically the 10-year bond will yield more than the 2-year. And that, as an investor, makes sense in kind of simple terms. If you're locking your money up for a longer period of time, you should be compensated for that additional risk. But there are times when the relationship goes negative, or the 2-year will actually yield more than the 10-year. And that's when we get what's called the inverted yield curve. So the opposite would be a steep curve, which we saw at the end of 21, suggests a growing economy, possibly higher inflation. But the inverted yield curve is an indicator of slower economic growth. Now, the curve inverted back in July of 22 remained inverted for over 24 months, which was a record, and then recently uninverted. So we'd have to go back to the late 70s, early 80s to see something similar. So the big question now, again, similar to the Somm rule, is this time different? Is there a chance the inverted curve breaks this incredible streak of predicting recessions? Now, I hate to say it, but only time will tell. But one argument for why this time may be different is because of the monetary and the fiscal policies that Brooks talked about that were implemented during the pandemic, and also the zero interest rate environment that we experimented with were really unprecedented. And we're still feeling the impact of those policies today. Just think about homeowners who are able to lock in their mortgages at 2.5% or 3%. They're spending less on their mortgage payments, so they can go out and spend more on travel or purchasing discretionary items. So it really is a kind of a wait and see to see what the longer term impacts of these policies are, and whether or not this time is different and we can avoid a recession. Now, another recession indicator is high yield spreads, also referred to as junk bond spreads. This gives us some insight into how lower credit quality companies in the US are doing. So if you think about smaller biotech or smaller technology companies, which are inherently more risky, the spread measures the difference between what it costs these companies, these lower quality companies, to borrow money versus what it costs US government. Now, historically, when the bond market senses that the economic landscape is deteriorating or there's a disruption in the market, the high yield spreads will widen. They typically widen pretty quickly as investors start selling these more risky assets. But with spreads at below 3% today, the bond market is signaling that it's not too concerned about a recession. So in comparison to the previous slide on the 2-10 spread, this is pointing to a more positive outlook for the economy. Now, this slide looks at the long-term history of Fed fund rates. Also shows the path of rate projections that is being made by the Fed. It also shows the market's expectation for Fed funds rates. So if you look at the current rate cycle we're in, Fed's raised rates aggressively from 0 to 5.5% to combat inflation. Now with inflation easing and the job market softening a bit, as Darcy mentioned, the Fed has begun to cut rates in order to get back to a more normalized environment. So based on the projections that are being made today, the Fed expects we are headed for a soft landing. It's on track to cut rates by potentially another 0.5% by between now and the end of the year. The Fed does have 2 meetings. They meet the day after the election in November, and then one more meeting in December. The market is actually pricing in higher rate cuts. We're looking at maybe 0.75% to 1% by the end of the year. So the Fed does have a difficult job. There's a lag effect to these interest rate cuts, so only time will tell in determining what the impact of the Fed cuts will have and if we can orchestrate this soft landing. The next slide here takes a look at the Fed's balance sheet. So for a long time leading up to the financial crisis in 2008, the Federal Reserve's balance sheet was less than $1 trillion. During the financial crisis, the Fed instituted quantitative easing to help shore up our banking system. As a result, the Fed's balance sheet increased to about $2.5 trillion, and then from there ballooned to over $4 trillion. And in 2018, the Fed announced it would start reducing its balance sheet, but then the pandemic hit and the balance sheet expanded to just over $9 trillion as the Fed was injecting liquidity into our markets. In 2022, the Fed began quantitative tightening again, which means they're allowing the treasuries and the mortgage-backed securities on their balance sheet to mature and roll off. The Fed is definitely walking a tightrope here because in order to reduce the balance sheet, it means the Fed is no longer a buyer in the markets. So they're reducing the liquidity in the markets. And that's been a concern we've been watching and watching very carefully. So far, the Fed has successfully reduced their balance sheet by $2 trillion, and we have not seen any disruptions in the market so far. But they do have a ways to go to get back to a more normalized balance sheet. So with that, I will hand it over to Evan, who's going to talk about some of the fiscal challenges the U.S. is facing.
Thanks, Steve. So I'm going to address government spending. So first off, our government generates revenue from taxing individuals and businesses, and then it turns around and spends those dollars on social programs, defense, and debt servicing. When the government spends less than it takes in, it's known as a surplus, and when more is spent than is taken in, it's known as a budget deficit. This chart looks at a budget deficit or surplus as a percentage of gross domestic product, or GDP, which is basically the sum of all the goods and services sold in our country in a given year. So when this line goes negative, it indicates a deficit, and positive indicates a surplus. So the large deficits here are during World War II in the 1940s, which was costly to fight. And then, of course, the aftermath of the Great Financial Crisis in 2008, and the pandemic in 2020. You'll notice, though, we have not had a surplus in over 2 decades. And the current level today at -6% is a historically low level. So what has all of this deficit spending translated to? The next slide will show you high debt. So going back to World War II, in the 1940s, debt as a share of GDP reached over 100%. Then in the 50s, 60s, and 70s, we had good growth, which brought this down to the 25% level. However, the financial crisis and pandemic have brought this back up to about 100%, with projections over the next decade reaching about 125%. So this has been an issue for quite some time. We keep kicking the can down the road. The counter argument to this being a problem is countries like Japan, who are running 250% debt to GDP as they deal with an aging populations and recessions and depressions. However, I don't think that is a goal that we're trying to reach. Steve mentioned this. Today, we've got 2 presidential candidates who are proposing lower taxes and increased spending. So that's only going to exacerbate this problem. I think a long-winded way of saying that unless we find ways to reduce government spending, we may be facing higher tax rates in the future. This is the US dollar index, which is a measure of the dollar against a basket of other currencies. The moves here are generally influenced by the interest rates set by both the Federal Reserve, our central bank, and central banks around the world. So as the Federal Reserve cut interest rates, for example, in 2007 and 2008 in response to the Great Financial Crisis, if we cut rates faster than other central banks, the dollar will decrease in value relatively. On the flip side, as we raise rates higher than other central banks, like we did in 2021, the dollar will appreciate. Today at 100, we have a very strong dollar. This is kind of a double-edged sword. For consumers, it's a good thing. If you want to buy imported goods, they are going to be cheaper. If you want to travel internationally, your dollars will take you further. However, for multinational companies that are trying to sell goods abroad, they're going to be relatively more expensive for those international consumers. And we, of course, have election in 2 weeks, so we needed a slide on that. This is the S&P 500 performance during election years. Going back to 1964, we have every elected president. We have the performance 12 months before the election, performance 12 months after the election, and then the calendar year return. There are some outliers here. In 2000, we had deeply negative returns after the dot-com bubble burst. 2008, we had deeply negative returns after the Great Financial Crisis. But those were really macroeconomic events that were driven by bubbles bursting and not necessarily who was elected president. If you look at the average of the performance 12 months before, it comes out to about 8.4%, and the average 12 months after comes out to about 9.3%. And I think that's a story that tells that the stock market does not like uncertainty. You know, the uncertainty of not knowing who will be in the White House and who will control Congress can hold the market back a bit, can create some volatility. But once we understand who's going to be elected, we can start game planning for those policies. And I think that's an important message here. So in conclusion, equity market performance has broadened, though AI winners have led. Stocks are priced to perfection. Valuations indicate a soft landing is the consensus. Inflation's declined nicely, and the labor market has been resilient, but there are some growth risks. The labor market has softened and can turn quickly. So as companies lay people off, those people stop spending, companies need to lay more people off, it can snowball quickly. We're starting to see higher delinquencies, particularly for lower end consumers. There's also some risk to inflation. So higher tariffs would certainly be inflationary, higher government spending, and geopolitical conflict escalation can certainly increase the cost of energy. Markets may experience volatility around the election, but are more influenced by macroeconomic events. And with that, we'll turn it over to Darcy to answer some questions.
Great, thanks, Evan. I think Christy mentioned this, but if anybody has any questions that they'd like us to answer in this webinar format, you can go to your Zoom toolbar and click on that Q&A button, and it should open a dialog box, and you can pop a question in there for any of us to answer. Why don't I start with this one for Steve. What are you doing in portfolios given that the stock market looks quite expensive at these levels?
Yeah, so it's a good question, one that we are dealing with and thinking a lot of, right, in terms of the market valuation. So the PE, which is the standard metric that most market analysts will refer to when they're measuring the valuation of the market, it's important to remember that the components of today's market are different than prior markets. So if you go back and look 20 years ago, finance and energy sectors made up about 30% of the market. Today, technology and communication services make up about 40% of the market. Now, a technology company tends to have a higher growth rate, higher profit margins than an energy company. So you could argue that the technology companies deserve a higher multiple. And that is true today. NVIDIA trades at about 65 to 70 times earning, and Apple is about 35 times earnings. So these are the largest components of the S&P 500 and are moving the averages of the S&P 500 PE higher. But if you back out the Magnificent Seven, so the top 7 companies, and you look at the remaining 493 stocks, the average PE is closer to 19 times. So certainly not a bubble. And there's also other areas of the market that we're looking at, whether it's smaller cap companies, international, which we have added to. Those are also trading at, we think, very reasonable PE averages.
Great. And then let's have Brooks answer this one. What are you doing in the bond market?
Good question. What are we doing in the bond market? Yields have backed up a little bit, and over concern that maybe the deficit spending is going to be putting pressure on rates. And so as a consequence, we've taken that opportunity to continue extending duration in portfolios. We started about a year and a half ago, maybe 2 years, to build bond ladders. And everybody in the room, I said, Steve, it's time for building a bond ladder. And everybody went, what? We hadn't done that in a very long time. So a bond ladder is a series of bonds in varying maturities, 6 months, 12 months, 18 months, 24 months. We did that first and then started extending the duration out to and added a 7-year bond and a 10-year bond, primarily about a year ago when Treasury rates were up near 5%. So we're just continuing to manage the bond ladders. As rates start to come down, we'll extend even further.
Great. How about this question? I might take this question. Do you think that there will be a soft landing? I think that we hope so. We hope, along with everybody else, that we will achieve a soft landing. But we also think that it really is our job to look out for what could go wrong. And I think that that's especially important in an environment, as Chrissy mentioned, where stocks are priced for perfection. They're 2 standard deviations higher in terms of valuation. They're extra expensive, if you will. So I think that we're optimistic, but we're trying to look for what are the risks on either side. Meaning, what's the risk that growth begins to slow and we actually do enter a recession, a period of slower growth, more unemployment, and kind of some economic hardship that direction. On the other hand, we are also looking for signs that inflation is not going to, continue its glide path toward 2%. I think that we're kind of equally weighting those outcomes and hoping for the middle, which is the soft landing. There are kind of, depending on the data point that you want to follow, depending on the month of the data release, it kind of is seesawing back and forth. As Brooks mentioned, in the beginning of August, we were worried, along with everybody else, that we're entering a recession. We had a pretty poor jobs number from the July data, and we saw the SOM rule triggered. So, maybe it is different this time, but it does make us a little bit nervous when we have to start using that argument. It's different this time. So do we think that there will be a soft landing? I will say it would be historically unusual given the aggressive rate hike cycle that we've seen. But we're hopeful that that is the case. Let's see, other questions here. Evan, you kind of addressed this one, but I'm going to ask it anyway. Who's going to win the election and which party will be better for the markets?
Well, I think that it's a very close race right now. The other interesting thing is that pollsters were wrong in 2020. So it's very hard to say who's going to win the election. As far as who's going to be better for the markets, we identified a couple of policies that could have some impact on some of the risks, like tariffs, like taxes. I think overall, the message that we're trying to get across here is that it's more important to come up with a disciplined investment strategy and stick to it and not let the noise of politics get in the way. I think the worst thing you can do is you know, sell out of your portfolio, go all to cash because you know the person that you didn't want to win is in the White House. At the end of the day, we have a government with checks and balances, and I think that those were put in place to prevent anything from going terribly wrong. So.
All right, well, I think that does it for the questions in the hopper, unless anyone has any last minute ones they'd like to submit. But please feel free to reach out to us after if something comes up or if you'd like to dig in further. And with that, I think we can conclude the webinar.
All right, thank you.
All right, thank you.
Thanks, everyone.
Bye-bye.